Good afternoon. Welcome to the TheoTRADE afternoon video. I am Blake Young, and today is September 25th, 2025, and we're going to talk about stocks that are going to struggle from a debt perspective. Now, I talked about this in an editorial you should be getting in your inbox here shortly, but I wanted to also highlight it in a little bit more broad way to how we can look for these types of stocks in this scenario. I commented on the idea of looking at the stocks like a banker would, and that is a banker is going to look at the market and say, when things are tight, when credit is tight, when we're concerned about the economy and we're concerned about the growth, a fancy, bright, happy story isn't going to convince them to lend you money. A well-told story is not going to get you more finance. And so when we look at this, we're looking for companies that aren't showing that they have the ability to pay their debt or are going to struggle to pay their debt if we don't have the perfect glowing future that maybe we put in our financials. So what I'm looking for specifically is stocks that are between the price of $25 and $600. So I want none of these $1,000 stocks, and I want them over 25. I want stocks that have weekly options, or we can even go here and say, let's go penny increment options. That's under the public watch list, and we go to penny increment options. As you can see, we've also got volume, 1 million shares or more. We have front volatility. I want to have some good volatility in our options, and because we're not looking for ETFs. And open interest, we want to be able to trade them, so we'll put 75 in there. But the main one I want to look for is current ratio and quick ratio. Now, current ratio and quick ratio, we will delete this one out. Current ratio and quick ratio, the main one I want to look for is quick ratio, because this says you have to sell inventory. Current ratio says, do you have enough short-term assets to cover your debt versus short-term liabilities? So current ratio is saying all of your assets, which includes inventory. Quick ratio says, let's say you can't sell your inventory. If the market really turns south, do you have enough to cover your debt? So 1 to 1 says you have enough short-term assets, not counting inventory, to meet your debt. Okay, so anything below 1 means that you don't have enough to meet your debt for the year as it sits right now, unless you sell inventory. And then I'm also looking at free cash flow. This is the blood force of any company, and we're saying, show me someone that has lower cash flow than they did the previous year, meaning 0 is our cap. And this will give us some indication of whether we can have the ability to pay our debt or not. Now, as I run the scan, you're going to see there are 69 stocks that meet the conditions. There we go, 47. We were at 69 with the weekly options. Penny increment options, so good tight spreads on the bid and the ask price. We have 47 stocks. Now, earlier there's 50 stocks, so we've had something move that changed the calculation. But notice the stocks that are in here. We have a bunch of energy stocks that are not in a situation where they can't sell inventory. So they don't have a choice but to continue to sell inventory. That's a good sign if we expect to see energy prices stay low. They have to sell energy. They have to sell their oil. But if we scroll down and look at some of the other stocks in some of the other sectors, we have industrials. We have stocks like Boeing, Lockheed Martin, RTX. So the aerospace and defense contractors, they're not doing great as far as capital goes. We have Caterpillar, Southwest Air. And if we look at these are all companies that are going to need to do something else and have increased income, not decreased income, to survive. And so we can go through the list and find all these different stocks that are maybe under pressure. And we can even sort these based off quick ratio and say who has the least amount of money. RH, Walmart, Altria. So these companies are ones I normally look for at the bottom of markets, but these are showing us that they're going to have to keep selling inventory. Home Depot, Vistra, Mondelez. But let's start with this Boeing. I really like the idea of looking at Boeing here. Boeing has had an interesting move, and we've already reversed and created the price pattern. We've created a high, a low, a high, and broke through that support level. To me, this is a breakout, a double top into a downtrend. We've now created a full set of lower highs and lower lows. So I would go into Boeing's trade tab and I would look at this and say, are the options cheap or expensive? So I scroll down to the bottom. The current IV rank is 20%. This tells me I might be able to get a long-term bearish trade by buying puts and selling premium against it and participating in this next big move. And to stick with the options, let's go out to January. And we'll just use January's option to give us a few months and buy the put. What kind of put? Generally, I want to buy in the money in a delta near 70. We could do the 240. Now, if I buy the 240, that's going to cost me $3,185. That may seem like a lot, but considering it's a $213 stock, that's not that much. And what we're going to look at is what happens if I sell a month's worth of time against it and a delta between 30 and 40. So I could do the 210 or the 205. If I sold the 210, this option is paying me $6 for selling a delta near 40. I'd still have November, December, and January to pick up more premium as it moves lower. And if I'm always moving lower and selling a delta between 30 and 40, this spread will get wider. But if I collect 3 more months of $6 to $7, that means my total cost for this vertical as it continues to move down will pay me more and more premium, reduce my cost basis down to about $6 total for a $30 spread. And the long side that I'd own would be 240, and we're currently at 213. So even if it doesn't move, if I keep collecting that premium of $6, my cost basis is going to be $6, and I'm going to be $27 in the money. If we're selling lower and lower, this could get wider and wider, more and more profitable as we go. So this is a very inexpensive long diagonal to participate in if Boeing continues to sell off. And we have about a 40% chance that we're going to reach that level, which means there is downside potential for this trade and a safe position to the top side. Every month we collect another $6 as it moves lower. And if we hit those lower targets and continue to move down in this chart, I think it's easily gets to 200. And if we break through that, the distance here from 240 to 220 would be $20 to 200 to 200 to 180. And if we go all the way to 180, again, with these options, then we're going to continue to collect that premium. And by the time we reach January, we will be in a vertical that is $60 wide that cost us a net total of $6. That becomes a 10 to 1 potential if that trend continues, and if we continue to roll the short puts into the upcoming months. And that's the kind of trades and strategies I'm seeing across the board in these stocks that are actually going to struggle to make their ends meet, pay their debts. So if we go back to the scan and say, yeah, we got Boeing. We also talked about Mosaic and all these others, but let's take something like, Starbucks. Let's do something fun like Starbucks. Do people continue to buy Starbucks? Well, sure. But could they start buying Starbucks and making it at home? Does this look like a bullish stock to you? If they're going to struggle and people tighten their belt and start making their coffee at home if things are getting tighter economically, then Starbucks has a lot more downside. Same kind of idea. They're going to struggle to make ends meet, to pay their bills. So we go into the trade tab, we scroll down, and we look at the options. Are they cheap or expensive? 26% off. They're getting a little bit more expensive, but still relatively cheap. And if we want to trade this for the longer term, we'll still use the January, and we're going to buy a January delta of 70 for $13.85. If I trade that, I'm still trading a fraction of the cost of Starbucks if I were buying it or shorting it. So that means we're going to pay $13.85, and let's sell that delta of 40 for 1 month, 30 to 40, and that's the 82. So I'm in an option spread, again, that is $7 wide, and so I do need to roll this. This starts us out upside down. We need to roll. But if I can get another 3 months at roughly $2, that's going to pay me $6. It's going to bring my cost down to $5.50 for a $7 wide. And by the time we get into January, if it just stays where it's at, I will have paid $5.50 for a $95 put. It's $13 wide, and I've got a 2 to 1 reward risk. It's not as nice as the 10 to 1 from Boeing, but if it just sits there and doesn't do anything else, then I pay $5.50 for something that's worth $7.50. If it rolls down and continues to do these patterns like we already showed, and if we keep stair-stepping down, notice this is going very rhythmically, 94 to 86. Right here from the high, 90 to 82. So every time we're looking at about an $8 move. Are we going to go from 86 to 78? Are we going to do that again, go from 78 to 70? We really could be looking at this continuing lower to get 70, if not lower, by the time we get to January, based off of how this is bear flagging down month after month after month. So we could see this continue to spread out, and we could see this go all the way to 70. And if we keep selling that delta 35 to 40, 30 to 40, then by the time we get 70, we'll have a $15 put vertical that costs us $5. So it'd be about 3 to 1 at that point. All of these stocks are setting up. So I'd encourage you to go through and kind of look at that list and say, show me the stocks that are going to have a hard time meeting their obligations, that are probably not going to get more money, lent more money because they're under pressure, and therefore they're going to struggle and the stock's valuation are going to drop. Then find the options that say, how can I play this in a way that continues to pay me as we move lower and lower and lower? These could be not just a few weeks, but could be months and months. We could take this past January into next year if the economy is slowing down as we're seeing it, and if the credit markets are going to tighten down in this environment. That's going to do it for me today. Join me again tomorrow. We'll look at some of the long-term trading in the main room. Otherwise, have a fantastic night, and we'll see you tomorrow.